session today. Today's session is going to be part 2 of the introduction to financial planning. The part 1 session has been already recorded, and we have tried to cover about introduction to financial planning and also some aspects with respect to the risk management. So I am Pramod Kanipakam. I am a certified financial planner since 2007, and I would be the faculty for most of your subjects and modules in financial planning, CFP curriculum. So before going ahead, let us try to understand what are the various aspects we try to cover in the first part, just as a quick recap before going to the current session. So in the previous session, we looked at what is financial planning. So wherein we discussed about financial planning as a holistic approach towards an individual's financial planning, wherein we are trying to mobilize all the resources of the client and try to fund the resources to achieve the goals, right? And then we also looked at financial planning as a process. What are the various steps involved in the process of financial planning? So anything when you want to achieve a systematic and a long-term outcome, you need to have a process in place, right? And when we look at a process for financial planning, FPSB, which is Financial Planning Standards Board, have a prescribed 6-step process which is internationally followed. And this 6-step process helps you to achieve in building a good financial plan for any individual clients. Now, what does this 6-step process include? It includes establishing the relationship with the client, wherein you try to understand what are his requirements and what is it you bring to table, right? The engagement conversation, what is that you are trying to help the client with, right? So in the establishing relationship, you try to ensure that both of you and your client are on the same page with respect to the engagement. And once there is a consensus on the engagement, then you go to the second part, which is about collecting the data. Now, a financial plan is going to be built based on the data that is being provided by the client and also based on various observations you make during the process of interacting with the client. Now, when here we are looking at collecting the data, there can be multiple ways of collecting data. It can be a standard questionnaire where you may share a questionnaire with the client and the client may be filling up those data points and sharing it back to you. It can be an interview. It can be a part of the discussion where you keep notes about what is the points the client is sharing with you. It can be multiple things, but the basic objective of data collection is you try to get as much information as possible, relevant information which is required for making a good financial plan and an advice for the client, right? And broadly, you look at the data as qualitative and quantitative. Collecting any kind of a quantitative data is very easy, but going to a qualitative data becomes very difficult. Now, if you look at a qualitative data, it is like the risk appetite, the quality of health of the client, right? The kind of risks he is associated with. These are very qualitative in nature. So we need to look at gathering data there. And after doing that, you have to start analyzing, wherein whatever the data you collected and whatever the inputs you have to start analyzing the data. And then once you analyze the data, you develop the plan. Now, a lot of your learnings in this CFP curriculum is going to help you in understanding what kind of data is required and how to analyze the data and how to put them into a particular financial plan, developing a plan. So your main skill set development is going to be in this space, right? And once you develop the plan, now when you are talking of developing a plan, now what is a plan here we are looking at? We are looking at a plan which includes how to manage the client's risks, which will include how to manage the retirement of the client, how to achieve the goals of the client, and also try to have a tax efficient system in place for the client, and also maybe some aspects of estate planning, wherein you can guide the client on having some kind of an estate planning. So putting this all together would be part of your financial plan. And once this plan is done, then you have to present the plan to the client in a very in a way where the client can understand what is being discussed, because we need to understand the client is not from this particular profession, or he may not have a core competency in this space. So you need to bring down all your analysis and calculations and recommendations to a layman's perspective where he can understand why it is being advised to him. And once the recommendations are made, then the implementation comes. Yes, the recommendation is going to be a midway of the process. Imagine somebody deciding to do something but not doing it. The outcomes are not going to be there, right? I may decide to go walking from tomorrow, but unless I start walking, I am not going to reap the benefits of it. So having an excellent financial plan without implementing the plan, I am going nowhere, right? So we need to ensure that it is implemented. So we need to give a plan of action to the client where you can tell him there should be a priority list also. Because when you do recommendations, there may be a list of things that needs to be done. And it is not that all the list can be done or executed in a one shot. So you may have to prioritize them. Let me start with this insurance. Let me get this done. Let me get this done. Let me have my emergency funding in place. Then let me start with an investment. Let me look at funding my short-term goals. Then maybe, let me look at what is my retirement plan. So you need to have a priority for plan of action also. Once you implement the plan, now it doesn't end there, then you should review the entire process. So that's your last stage or the sixth stage, wherein when you look at reviewing, we are talking about the entire process being repeated. Now in review, we need to understand, most of the times people think review wherein some kind of a wealth passed on from his family. It can be any of these things. And all these changes are going to impact the financial plan which is already developed. So when you review the plan, you should ensure that all these things are being taken care of. So this is your 6-step process. I try to spend a little bit more time on this primarily because having an understanding of this is critical, right? So if you look at the CFP curriculum, this basically fits into the 6-step process when we are talking of an investment planning specialist, retirement and tax planning specialist, risk and estate planning specialist, and finally a certified financial planner, whereas it is an integrated financial planning. So you will have 4 papers to clear here. So we looked at risks, when we looked at risk of pure risk. So here, just to remind you, typically people look at risks as uncertainty. Risk is something where there can be a loss possibility. But when we look about insurance and risk management, we are talking of something called a pure risk. Now, how does it differ? Now, when there is a risk involved in an equity investment, or when you are trading into shares or investing into shares, right? Or when you are buying some kind of an asset, right? There is always a possibility that there can be a loss, there can be a gain also. But the kind of risk we are dealing with when we are talking about insurance or risk management here is pure risk. Now, what happens with the pure risk? Pure risk is primarily a risk where there is a possibility of a loss or no loss. No gains can be taken from here, right? And then we looked at perils and hazards. Peril is the cause of risk, right? Like fire is the cause of risk. A fire accident wherein the fire is the source of loss, the peril is the fire. Now, we also saw about hazards, right? So what is a hazard? Which can enhance the possibility of the losses. Now, the possibility can be in the increasing the probability of an event happening, or when the event happens, the intensity of loss, right? So we saw about physical, moral, and moral hazards. And in the risk management techniques, we also discussed that once you identify the risks an individual is exposed to, we look at what are the different strategies we can have. Now, in the different strategies we can have, we looked at risk avoidance, risk minimization or reduction, risk transfer, and risk retention. And here we focused on risk transfer, which is on insurance, where you transfer the risk from individual to the insurance company. Or insurance company is basically collecting the risk from multiple people. So transferring from individual to the group is what is being done by the insurance company. Right? And then in the risk management process, similar to the 6-step process, we saw various aspects. And just to give you again a quick recap of, because today we are going to discuss more about insurance, a little bit of touching on this space would be beneficial for all the people listening to this video. Here, when we look at the risk management, we are talking of individual risks. And in individual risk, we are talking of pure risks and individual phases. Let us get it. Individual risks, pure risks. And here, we looked at life, wherein the loss of life, right? So, death. Death is an uncertainty. And what is uncertain about the death? The uncertainty about death is not death itself, because I am sure death is certain. The uncertainty about the death is the timeliness of the death. When the death can happen is what is uncertain, right? Imagine all of us having a expiry date we get for a lot of the products. Imagine we all come with an expiry date. Then we are all very sure that nothing is going to happen to me till my expiry date. But we don't come with something like that, right? So the death can happen anytime. So that uncertainty of when the death will hit you is what is being covered with life insurance. So loss of life, loss of health. falling sick, having some kind of a medical emergency, right? That is again a risk. And then disability, physical disability, impairment of maybe loss of vision, loss of limbs and things like that, where your ability to be productive, your ability to generate income is drastically affected, right? These are at a personal level. And then you can have risks at a property level. I am having a car. My car, there can be a possibility that it can meet with an accident and there can be some losses arising out of that. I am having a property, a building where I am living. There can be an earthquake, or there can be a fire accident. There can be a burglary. There can be any of these events that can happen, where I can have loss of omission and commission, where you may be liable to compensate in case of any damages happening to your clients, or any of the service offerings you have, right? So there have been cases like, in case of doctors operating by mistake to another part of the body. You were supposed to operate a right leg, but then you ended up operating a left leg or something like that. So there can be acts of omission, right? There you need to understand that the professional liability can be there, and that liability can be covered by liability insurance. So we saw personal, property and liability, and there can be various other aspects also, but at this level the broad understanding of these three will help you. And once you identify these risks, we need to evaluate them. So that's what we see. If you look at the previous video, I tried to provide a matrix: probability of loss and intensity of loss, and wherein we are telling that based on the matrix where the risk is associated, you try to use an appropriate strategy. Like in the previous slide, we saw the strategy of avoidance, risk mitigation or minimization, risk transfer and risk retention. So you choose any one of them, and again you have to implement that, whatever the strategy you decided. And once you implement that, again monitor, review it again and again, because the risks you are exposed to itself can keep changing, right? And then we looked at underwriting. So when we looked at underwriting, what we saw was, when you are trying to handle the risk, right? You are trying to transfer the risk is one of the strategies, wherein you are trying to say that my insurance company will cover the losses. Now, when an insurance company is trying to cover the losses, you think the insurance company will cover all the losses? No, the insurance company will not cover all the losses. They will have their own approach towards evaluating the risk, and underwriting is such a process. So you can see here, the process of underwriting is about determining whether a risk is reasonable to accept and at what price. Should I accept it? And if I am accepting it, at what price? And also, you also look at how much the premium he has to charge for that, and if there is any kind of a restrictions he wants to put on you. So all this will be part of your underwriting, right? We will discuss more about underwriting in detail at a later point in time. Then we also saw that, can all risks be insured? No, all risks cannot be insured. Now, what are the risks, the requirements for a risk to be insured? Or that is where we are telling the requirements for an insurable risk. If you want a risk to be insured, it should satisfy these criteria. What are the criteria? The first thing is the law of large numbers. Means there should be many people or many individual units which are exposed to similar kind of a risk, right? So large number of people or large number of assets, right? Like I am talking of insuring my motorcycle. There should be n number of motorcycles, which can be insured, and my bike is also going to be one of them. If I am talking of a motor car, I am telling there should be n number of cars. There's a large number of cars that needs to be there, and my car is also going to be one of them. There should be a large number of them. There can be exceptions to this, but we are telling the thumb rule is there should be large number. There can be exceptions, like there are people like maybe a football player, trying to insure his legs, right? Or maybe, some other professional trying to insure some part of his body, which is very important for his profession. That is exceptions, okay? Now you can't say that, I want so many people, who are football players, of equal competence and of equal value. Need not be. So it's a different type of underwriting. But generically speaking, you need large number of exposure units. The loss must be by chance. Now, what does that mean? The loss must be by chance. It should be accidental. When we are talking of in insurance, the risk what we are referring to should be an accidental loss. It should not be a loss which is planted or which is planned, right? Because the entire insurance industry works on what is probabilities. I am trying to look at my past historical data, and then I am trying to project the kind of losses or claims that can be anticipated. Now, that is going to be purely based on the risk which is inherent in the event, not that there is a specific influence where people try to manipulate the outcome or people try to create that event. So if it is accidental, it is fair. If it is intentional, it is not fair. So here they are telling that it should be by chance, that is accidental. The loss must be measurable and it should be defined. Now it's very important that when we are talking of insurance, we need to ensure that the losses that we are discussing in insurance, there should be some measurable value and it should be clearly definable. Now, why is it important? It is important because insurance is not about buying a policy or buying a risk coverage today. It is going to be of the real value when the event happens. Imagine that when the event happens, then there is a disagreement between how much compensation should be paid. It is not serving the purpose, right? If there is a loss for let us say you have a car which is worth 10 lakh rupees, right? Today we need to agree what is the kind of insurance amount we are going to have on the car. We cannot say that at the day when the losses happen at that time, let us figure it out. No. We need to know exactly how the process is going to work, how the entire claim settlement, the amount of claim that is going to be settled, all these factors needs to be measured and defined in the beginning when the policy is being issued. So when you are trying to cover a risk, there should be a variable where you can define clearly that this is the amount of value I can put for this. And then finally, the losses should not be financially catastrophic. Now we need to understand an insurance company is into the business of providing risk coverage, right? Or helping you manage your risks. They are into profit making. They are not into charitable institution, right? So all the insurance companies, they have designed a model wherein they figure out that there is a need for risk management in the market. So I will create product where people will come and transfer the risk to me, and I will ensure that I am collecting enough premium to pay the losses and also make some profit in the process. Now, if there is a catastrophic losses, financially catastrophic losses, which means that huge magnitude of losses happening, in those kind of scenarios, you may not be in a position to compensate them, right? And in that context, they are telling that it should not be catastrophic. So we have actually covered till this particular slide. Now, let us look at what is an insurance contract. So in the last session, we also discussed that there is a small difference between insurance as a contract and insurance as and other investments, which is not a contract. Now, most of the other investments are transaction oriented, right? So I go to a bank, I open a bank FD or a fixed deposit. What is happening? I am just going and buying a deposit. I am putting my money and buying a deposit. That's it. When I am going and buying a mutual funds, what am I doing? I am transferring a particular amount of money and I am buying units equivalent to the particular fund transaction. But there is no contract or there is no future commitment that is promised in that. But in insurance, what happens is the parties, the insured and the insurance company, both of these people, they get into a contract, and the contract is an obligation to pay into the future. Because when you are entering into the contract, there is no obligation to pay today. The obligation to pay for the insurance company will only come when there is a claim happening, right? Or when the policy is maturing in case of life insurance. And that is going to be much ahead, in the time. It is going to be much later in the future. So it needs a contractual obligation from both the parties and predominantly from the insurance company. Now, so because it is a contract, we need to understand that there are various aspects of the Indian Contract Act which is applicable for a contract. Now, what are some of them? So if you see some of them, it should be for a legal activity. When we are talking of insurance, we need to ensure that the insurance is being dealt, or the subject matter of insurance is something which is a legal accepted in the country where it is being offered. So I cannot go and buy insurance on something which is illegal, right? Let us say that I have a warehouse, and in the warehouse I am storing something which is illegal, right? So there are multiple things in India which is illegal. Maybe it can be drugs, it can be something which is the wildlife animal related products and goods which you are not supposed to be holding or buying and selling them, right? So any of them, if you are holding some of them and then you go to an insurance company telling I want to insure these valuables, then it cannot be covered under the Contract Act. Even if unknowingly it is covered, there is no obligation because it becomes a void. The contract becomes void because the legality is being questioned. It should be in the given jurisdiction. Now, when we talk about the jurisdiction here, in Indian context, right, we have life insurance and general insurance as two separate domains. Now, what are the offerings made by the life insurance company cannot be offered by a general insurance company. Similarly, what is offered by the general insurance company cannot be offered in the life insurance company. So the regulator is very clear when he is giving the license, what is that you are allowed to offer in the market. So you need to play within that jurisdictions. It should be between legal parties. Now, who are the two parties in the contract? One is the insurance company and the other is the insured. Now, the insurance company should be a legal party. Now, how does insurance company become a legal party? A insurance company becomes a legal party when they have a valid license to operate, right? The license for insurance in India is given by the regulator called IRDA, Insurance Regulatory and Development Authority. Now, when anybody wants to offer insurance services and products in the Indian market, they need to apply to IRDA and get the license. So when you have a valid license, then comes in your jurisdiction, you can operate. Now, when you look at the insured, right? So when insured being an individual or the respective representative, right? So he has to satisfy the contract act obligations. Like he should be a major, he should be of a sane mind, he should not be prohibited from getting into any kind of a contract. So there are various basic requirements which you should be dealing with. So both the parties should be legal. So that is the reason when you look at life insurance, a father can buy an insurance policy on a son who is a minor, but a minor person cannot buy an insurance on himself because he is prohibited legally to get into a contract, right? Similarly, you need to have an offer and acceptance. So when we look at offer and acceptance in the insurance contract, who is offering? The insurance company or the individual? Most of the times we think that the company is offering insurance. No. Here, the subject matter of discussion is risk. And who is offering the risk? The insured, the person who wants the insurance cover, he is offering the risk. So the individual is going to the insurance company and he is telling the insurance company, I am having this particular risk, I want to be covered. So can you please take this risk? So he is going and offering the risk. And when he goes and offers the risk, then the insurance company will have an underwriting team where they will underwrite. So if you saw a few slides back, we discussed about underwriting. So they will look at underwriting the risk and see that this risk can I insure? If so, what is the cost? If so, is there any conditions I need to put? So they will evaluate all this and then come back to the individual and say, yes, I can take it at this cost. I want you to do these kind of conditions. No, I cannot take it. Please come back later. Or outrightly reject. This is some kind of a risk we don't accept. So they can accept, they can reject, or they can postpone. They can do any of them, right? So the individual goes to give the risk to the company. So he is the one who is offering. The company may accept. So offer and acceptance, you need to understand in that context. Provide for some consideration. So we all know that in contract, if there is no consideration, then the contract is void. There should be some kind of a value in the transaction, right? Now in consideration here, there are two things. One is the premium paid by the individual, right? When I am telling you, please take my risk, then you come back to me and tell, please pay this kind of a premium. So that kind of a premium I am paying. Now that is going to be a payment from my side. Now what is that the company will pay? Now what the company pays is when there is a claim, the kind of a compensation which they have already committed to me in case of eventuality of any losses or anything, those payments will be made to me. So the consideration here is both sales. One is ending up paying the premium as asked by the company, and the company is paying the compensation for the losses as and when it occurs, right? So that's what the consideration we are looking at. Now what we saw till here is about the contract act, but besides this, there are a lot of other aspects which we need to look at. Okay, so these are the most unique concepts which are applicable with respect to insurance. Most of these things would not be applicable in your other investment space, right? So it is very interesting for us to understand when we talk about insurance, there are very unique rules and very unique concepts which are governing this particular domain of finance. Okay, now let us look at the first one. First one is called insurable interest. Now what is insurable interest? You need to have an adequate interest in that, right? So similarly, we will go to the next slide where details are there. So you have insurable interest, you have indemnity, we have something called utmost good faith, and something called subrogation. So we need to look at all the four of them. Just a second. Yeah. So if you look at insurable interest, what is insurable interest? Can anybody go and buy insurance on anything in the market? Can I go and insure your car or your house? I cannot. I cannot insure your car, I cannot insure your house for the basic pretext that I do not have an insurable interest in that particular asset. If there is a loss or there is an accident on your car, who is going to face the losses? The losses is going to be happening to you, not for me. Right? So the insurable interest is a legal or equitable interest that is held by the insured in the insured's property or life. So it can be property or it can be life. Similarly, I can't go and insure my neighbor, right? His life is of value, his life is of importance, but the direct losses in case of him dying is going to be for his immediate family, not for me, right? So when we are talking of the legality here, we are telling there should be a legally interest of insurance, wherein if something happens to him, I should face the consequences, I should bear the losses of that, right? In economic terms, it applies where an insured has suffered a monetary or economic loss through the damage or destruction of subject matter of insurance. So what is the subject matter of insurance? Life, the individual, property, assets like a car, house, whatever it is, warehouse, whatever it is. If a damage happens to that, I should be the person who is having the loss. Then I have an insurable interest in it, right? I cannot have somebody else having insurable interest in my car, right? I can insure my family members because I am the one who is going to get directly affected in case of loss of life for them. So insurable interest specifically refers to that. Now here we need to understand insurable interest has different applications at different places. Now as a father, right, I may have an insurable interest on my son. Okay. As a owner of the property, I may have insurable interest on my house. As a tenant, do you have an insurable interest? Yes. As a tenant, my property, my assets in the property also can get damaged, right? So when it comes to property, the owner has an insurable interest, the tenant also has the insurable interest. Now look at the tenancy. Now if the tenant is taking a insurance, let us say that there is a property, a 2-bedroom house or a 3-bedroom house where an individual is staying with his family. He wants to insure the flat. Now he has insured the flat, so the insurance is going to be for 1 year. But after 6 months, he vacated and he shifted to some other location, and the same property somebody else enters as a tenant. Now his property got damaged because of some fire accident or some short circuit or something. Now can the previous tenant claim because he still has the insurance? No, because the moment he vacated the property, his insurable interest ceases to exist, right? So the insurable interest should exist at 2 times. Please observe this. The insurable interest should exist at 2 times. One, when you are taking the insurance, there should be insurable interest. And it should also have an insurable interest when there is a loss happening. Now, there are some exceptions everywhere. Here also there are exceptions, right? So, we will deal with the exceptions at a later point of time. Similarly, an employer can insure the employees because the employer has an insurable interest on the employee. If tomorrow something happens to the employer has put so much of his time and resources on training the employee and putting him on job. So tomorrow if something happens to him, there is a direct financial loss or impact on him. So an employer has an insurable interest legally. Similarly, creditor, right? So if I am giving you some kind of a loan, right? So let us say a lending organization gives you 5 lakhs of loan. Now you are owing that amount of money to that lending organization or the company. So that company has insurable interest to that extent only. So if they have given you a loan of 5 lakh, they can cover you till 5 lakhs, right? And maybe interest in case, whatever the interest recovery is there, or maybe if there is something like that, but they cannot cover you beyond that. Whatever is there due to recover, right? To that extent only they can insure you, right? We discussed about the change of insurable interest, wherein we saw that the tenancy, when people are moving in and out. And insurable interest, I thought there is one more exception, right? So there is something called, Married Women Protection Act, MWP Act. Okay. Now this is specifically for life insurance where a husband life is insured and the wife is given as a beneficiary or the nominee. Okay. So let us understand. This is covered under Married Women Protection Act. Now what happens here is when you buy a policy, you should mention that this policy is being bought under this specific provision. Now, when you take a policy in that specific provision, there are various benefits of it. One is the benefit is going to be given only to the spouse. Now, the catch here is tomorrow, for some reason, you are separated from her. Still, if there is any money coming in, that will still go to her. You cannot change the nominee. In all the other policies, you can change the nominee at any point of time. But if you have bought a policy under the Married Women Protection Act, right? So then you do not have a provision to change the nominee, right? Even when you are divorced, in case of something happening to the money would still go to the spouse, ex-spouse. Now today they may be separated. So the insurable interest there, as we said, may not exist at the time of the event happening, but still as an exception it is covered. This is primarily to ensure some kind of a financial security for women, right? Then comes indemnity. A lot of us would have come across this word indemnity in various places, right? Indemnity bonds. So we keep coming across this word indemnity bond. So where do we come across this word indemnity bond? So indemnity bond is where people say, I will compensate for the losses. Let us say, predominantly we come across something like this in employment, right? So you are getting a job into a particular organization and they ask you to sign an indemnity bond. They'll tell you, say, if you are going to leave my job opportunity within 3 months or 4 months, right? Then you have to pay me because I am going to incur so much of cost in training you and all. So if you are leaving before this particular time frame, you have to pay me whatever is the cost incurred. So maybe X amount of money, few lakhs of rupees, right? So to that extent, you sign a bond with the company. That is called indemnity bond. Means I will pay for whatever money you incurred on me. And when I leave the job, that is a kind of a loss you have. Now, indemnity is basically that particular concept. The insured will be restored to the condition he or she was prior to the losses. This is most important, right? Let us revisit pure risk, loss and no loss. Now, when I am talking of insurance, I cannot leave the person in a profitable position, right? So I will only compensate you to restore the condition which existed before the loss. So before the loss, if there is a situation like this, after the loss, I will compensate you to an extent to bring it back to that situation. That is called indemnity. Now, typically it is said making good for losses. I will compensate you for the losses, making good for loss. That is what is indemnity, right? Now, the entire insurance works on this indemnity. I am going to compensate you for the loss. You may have an insurance of 10 lakhs on your car. But if there is a minor accident where the claim is only 10,000 or 20,000 rupees, I will only pay you 20,000 rupees. I am not going to pay you 10 lakhs because I am covering your car for 10 lakhs. I am going to cover to the extent of loss that you are incurring and bring it back to the normal. I will not let you profit out of it, right? That's what indemnity means. Insured cannot make profit. We looked at the accidental damage. Now, there are various other slight modifications that can be applicable in indemnity. Okay, so we are telling making good for the losses, right? So let me come to a small example here. Let us say you have a let us say that you are having a medical insurance. I will take medical insurance so that it becomes more sensible. So you have a medical insurance for 5 lakh rupees, right? Now, when this particular amount is the coverage, and let us say you have a claim for 1 lakh. So during the policy period, there is a claim for 1 lakh. Now, what will the insurance company do? The insurance company will pay you the claim of 1 lakh based on conditions. Maybe, there may be condition of copay, wherein they may say that, you have to pay so much, right? So if we will discuss copay and all at a later point of time. Let us say if there is a 20% copay, right? Which means that the individual will have to put 20% from his pocket and the insurance company will give the balance. So if 1 lakh is the claim, 20% will be paid from his pocket. That is 20,000, 80,000 will be the insurance companies. Similarly, if the claim is 2 lakh rupees, then he will end up paying 40,000. The balance would be given by the insurance company, right? Now, here we need to understand there is a concept called underinsurance. Okay. Now, what does underinsurance mean? Just let us just see, Now, when you look at underinsurance, if there is a property or there is something which is of worth 10 lakh rupees, okay. So let us say that there is a property which is worth 10 lakh rupees, okay. 10 lakh is a property worth, okay. So what happens if there is a damage to the property, the entire destruction of the property, it is going to be 10 lakh loss. But you know what? You will only insure it for 5 lakh. 5 lakh is the insurance. You insure it only for 5 lakh. Now, what does that mean? That is what we are talking of as underinsurance. Now, when you are insuring it for 5 lakhs, what is happening to the balance 5 lakhs? 10 lakh is the total value. 5 lakh is what you are insuring. Now, the other 5 lakh is the underinsurance, which means if you look at the previous strategies, we saw risk retention, right? So, this will fall under risk retention, and this is risk transfer. So 5 lakh rupees, I have transferred the risk on the insurance company. The balance 5 lakhs, I have retained it. So when I retained 5 lakh, the loss is on me. The insurance company will not bear it. Now, which means it is coming under underinsurance. When I am having a 10 lakh asset, 5 lakh insurance, it is underinsurance because the balance 5 lakh is on me. Now, let us see what happens if there is a loss of 1 lakh. If there is a loss of 1 lakh on this asset. Now, because it is insured for 5 lakh, do you think they will pay you the entire 5 lakh? They will not pay the entire 5 lakh. Now, when the loss is 1 lakh, then the company will come to you and say, see, you have transferred only 50% of the value risk to me. The balance 50%, you retained it. So today there is a loss of 1 lakh rupees. So you bear the 50% loss. I will pay you the 50%. 50% of the loss is paid by the insurance company, which is 50,000. The balance 50 is on you. Similarly, let us say the entire property is destroyed. This entire thing becomes 10 lakh loss. The entire 10 lakh is lost. Now, 5 lakh is what is the insurance company's obligation. So they pay you 5 lakh and they tell you do the balance 5 lakhs. Now, that is the impact of underinsurance. If you do an underinsurance, you should understand to the extent of underinsurance, it is a risk retention, which means I am responsible for compensating the losses for the underinsurance, right? The insurance company will not pay. The point to be noted here is the insurance may be covered for 5 lakh, the loss may be 1 lakh, but still because it is underinsured, the insurance company will not pay the entire amount. Okay, so that's the point which I want you to note here. Okay, so that's the exceptions and the impact of being underinsured. Now there are some exceptions with respect to indemnity. Indemnity is the important aspect in insurance, but there are some exceptions. Now what does indemnity say? Making good for loss. So to make good for loss, first is there should be a pre-decided condition. What is the amount, right? Now here for life insurance, there is nothing called indemnity. There is nothing called indemnity. So in life insurance, there is no ceiling that, I am going to insure to this particular extent, right? So you cannot say that, this fellow's life is value only so much. This fellow's life is worth 5 lakh only. This fellow's life is only 10 lakh, right? If you have a car, which you bought it for 10 lakhs or 15 lakhs, you know the value of the car is 10 lakhs or the value of the car is 15 lakh. But how do you know the value of the life? So indemnity is not applicable because there is no cap on it. There is no decided value on it, right? But there is a decided value which comes in. Let us say that there is Mr. X today who is just working as a very small employee in a company. Now he may be given an insurance of maybe 5 lakh, 10 lakh, 15 lakh, 20 lakh based on what kind of income he is generating. The same guy tomorrow can become an entrepreneur and he may end up making a successful business and he may be worth millions and millions of rupees. At that point of time, he may be in a position to buy more insurance, right? But can you say that in future I am going to become a very successful businessman, so insure me today for that, then the insurance company will go through the underwriting process where they will say, sir, at this point, they cannot say you are not worth this amount. They will only say at this point we can cover you for only so much. Again, when we say in underwriting there are different levels of underwriting. One is your health medical underwriting, right? So they will see, is this fellow's health absolutely fine, or is it within the normally allowed deviations. Similarly, there is something called financial underwriting. How much insurance can I give this guy? Now let us say he is earning 5 lakh rupees. So they will say, I can give you up to maybe 1 crore, 2 crore, whatever it is. If he is earning 50 lakh rupees, maybe the amount will become much bigger. So the amount of cover is a function of various things. So that is what the underwriting decides, how much cover to be given. So at this point, indemnity has an exception. Life insurance is that particular exception. Similarly, valued policies. Now, what is a valued policy? So valued, as we saw, one of the conditions for insurance is there should be a clear measurable value for the losses, right? So the loss should be definite and measurable. Now here what happens is, it may be slightly difficult to value them. So there is always a pre-agreed amount. So both the parties will agree that for this, if there is a loss, I will pay so much, right? So there are events being organized. Now events can be insured. Now, when you are insuring an event, they will say that, okay, in case of anything happening on that event, so this is the kind of losses we are going to compensate, right? So very subjective. So because it is very subjective, they come to a consensus, and those policies are valued policies. Again, these are exceptions to indemnity. So in indemnity, you are not talking of, indemnity, you are talking of making good the losses, but in valued policies, you are not talking of making good of losses. That's what we need to understand, right? In the valued policy, let us say that I am insuring a particular contingent, some kind of a, let us say transport, there is something which is being transported from point A to point B, right? And that particular goods under transport is being insured. So then I will say, I will insure this for, let us say, 5 lakh rupees. Now, irrespective of the amount of losses, I will compensate you 5 lakh rupees. The damages could be 1 lakh, 2 lakh, 3 lakh, 4 lakh, 5 lakh, whatever it is. The pre-valued agreement is that in case of any loss, I will pay you 5 lakh rupees. Right? So in indemnity, what happens? Making good for the loss. But because it is a valued policy, even if the loss is only 1 lakh, because we agreed that it will be completely paid for the entire value agreed upon, you will end up paying 5 lakh. So again, there the indemnity is not applicable. So these are the two primary exceptions. Now, what are the various other things? We saw the list of factors, right? The other things, something called utmost good faith, in Latin called uberrima fide or uberrima fide, right? So, which means utmost good faith. Now, why this becomes important? When you look at insurance, we need to understand the insured is the person who is going with the risk to the insurance company and telling you, please insure me. Now, do you know anything about the person coming to your company and telling, please insure this risk? You have absolutely no clue what it is, right? Let us say somebody is coming and telling, insure my life. So if Mr. X is walking into a life insurance company, and in current context, they are only logging into your website. They are not even walking into a company. They are just logging into your website and entering the data, right? What do you know about him that your underwriting team will try to evaluate? The underwriting team is going to evaluate purely on the data given by him or the information given by him. So the principle or the doctrine of utmost good faith becomes very, very important, wherein it says that it is the highest degree of honesty and sincerity. Whatever information you are giving me, ensure that you are having highest degree of honesty, because I cannot go and validate them. And my decision to give or insurance or not to give insurance is purely dependent on that. So please give with utmost sincerity. There is a pre-contractual duty to disclose, because the contract is happening when the insurance is given. That is when the contract is happening. But this is a condition for pre-contract. Before the contract is given itself, this utmost good faith ensures that the person who is giving the information should give it with complete truth and honesty. No kind of hiding the facts, no kind of misrepresentation, no kind of false informations, right? Now here, as I said, the insured has the greatest knowledge about the risk being proposed because he is giving the proposal, right? Risk to the insurer. So the insured should be required to disclose all those facts. This is the underlying point, okay? Now what should you disclose? You should disclose all those facts. I think we need to underline this. Do I need to disclose everything? When I am talking of life insurance, should I tell him what breakfast I had, what lunch I had? It's not relevant. I don't have to disclose all facts, all those facts that might influence the underwriter to accept the risk or not to accept the risk, or in case of accepting any kind of a terms being given by him. So this entire objective of giving data and collecting data is to evaluate the risk. So you should not hide or you should not misrepresent any information which is called as a material fact. Okay, we are not using the word here, but technically it is called a material fact. There is a fact, there is a material fact. Okay, now what is a fact and what is a material fact? A fact, I ate today for idli some dosa. It's a fact. I weigh maybe 75 kgs. It is a fact. But my weight is a material fact. What I ate for the breakfast is not a material fact. It is of not much of a relevance, right? What is my habit? Am I a smoker? Now, if I am telling that I have a habit of smoking, that is a material fact. Which brand I smoke may not be relevant, right? It is a fact, but it may be irrelevant. So, your material fact is something which has an impact on the underwriter's thought process or evaluation when he is doing the risk assessment. So, a material fact is something which can impact the underwriter's decision and thought process when he is underwriting the risk. All other facts are normal facts. So if you are giving or hiding facts which are not relevant, right, it is not a material fact, it's okay, right? But if it is a material fact, utmost good faith tells that you please disclose them. You have a duty of disclosure, pre-contractual duty of disclosure, right? Similarly, there is a post-contractual duty also throughout the policy period, right? Now, even once the policy is issued, this good faith and the post-contractual duty exists. Now, what is a good faith? Let us say that they are insuring your property for, they are insuring your property for fire insurance. Now, they may tell you that every floor you keep, one ceasefire or one fire extinguisher, right? Now, when they tell you that, it is your contractual duty to keep that, and they believe that you will implement it with utmost good faith, right? So, there is a pre-contractual duty and post-contractual duty. And whenever you are applying, right, for the renewal of the policy, you have to disclose that. They will ask you, what are all the conditions that is laid out to you? Are you keeping those conditions? Then when you say, yes, I am keeping those conditions, that is what is utmost good faith. Disclosure post-contract, right? So the previous one is indemnity and this is about utmost good faith. Very, very basic foundation for your insurance contract. Now, when we are talking of duty of disclosure, right, in common law, each party to the contract is under a duty to voluntarily disclose the relevant information to the other party during the negotiations leading to the creation of the contract. Typically, any contract, we are not talking of insurance here, any contract, when two parties are sitting and discussing, whatever is relevant to the contract, you are supposed to disclose it. A failure to disclose any material fact, so underline this is what I was telling you. A failure to disclose any material fact allows the innocent party to void the contract from the beginning, which means that if you hide anything or if you misrepresent any material fact, though the contract is done, though the policy is issued, subject to conditions, I may reject the claim telling that you did not give this information. You have hid this information at the time of applying for insurance. You did not disclose this information, so you failed to comply with the utmost good faith principle of disclosure, right? For general insurance contracts, the duty of disclosure is required when completing a proposal and again on renewal of the contract. I was telling you a few seconds back that in general insurance, whenever you go for a renewal, again there is a disclosure that is asked. Are you keeping all these things in place? Like, drunk and drive offense. Have you been booked in the past for any of these things? Right? Which means if you have been booked, it may be a downside, they may increase the premium or they may reject the policy itself telling that, no, we won't insure you. Smoke alarm installation. So you have a warehouse. and you are trying to insure the warehouse. So they are giving you an insurance policy telling that you need to provide proper smoke alarms or maybe firefighting systems in place. Now when you are going for a renewal, they will ask you to disclose whether they are functional, they are in good shape, that they are operational. Now that is when you disclose it. Maybe it may be a small checkbox telling it is all functioning fine, but when you do that, it is a duty of disclosure. And if you are telling my fire extinguishers are working, my water, my water pipes which is required for extinguishing the fire is all working fine, but few weeks down the line when there is a fire and then they figure out that none of these things were functional, then they can always go back and say you have hid the facts, right? You have hidden the material facts and you have disclosed that they were all functional, which is wrong. So they may even deny the claim based on that. So that's what we are referring to here. Now we need to understand here one important aspect, guys. The first thing is, when we look at insurance, it is not just about getting insurance. I want you to understand that. The objective of buying an insurance or covering a particular risk is that I am compensated at the time of event. So if you have to face any difficulties, try to face the difficulties today by putting all the disclosures, give all the disclosures, give all the material facts. The insurance company may ask for more information, give all that information. It is better to face difficulties today at the time of getting the insurance rather than struggling to get a claim settled. Right? So please keep that in mind. With respect to insurance, it's very important. Now we saw about material fact, and we saw that material fact is something which can influence the decision of the underwriter with respect to the risk, and some aspects which can be material facts, right? So occupational hazard. Now when they ask you about, let us say when you are talking of a health insurance or a medical insurance, they may ask about where do you work, what is your job. Now with respect to your job, there can be some hazards, right? So let us say somebody is working in oil rigs, or somebody is working in a mining, or somebody is working in some kind of excavations. Now there is always a risk which is associated to this profession. Everybody is not exposed to that risk, but people in that profession are exposed to it. People working in some kind of industries, chemical industries, where they may end up breathing some kind of fumes, right? Or cement industries, where there can be a particular amount of dust and other factors which can affect their breathing capacity and their health of their lungs and things like that, right? So they are occupational hazards. They may ask you for more details. So the moment you mention that this is where I work, they will come with a questionnaire. They will tell you, please fill up this questionnaire, which is called occupational questionnaire. So wherein with respect to your occupation, they will ask more details. Health history, again material fact. They will try to ask you to understand, are you a healthy person with respect to your age? Let us say you are a 30-year-old guy, 30-year-old guy, they have vital details like this, right? So height, weight, what is the kind of other health aspects, BP, let us say all your other blood related tests and all. So if you are going for maybe 2 crores, 3 crores cover, right, they will try to do all this medical checkup done, and they will see if everything is standard. And they will also ask you about the past medical track record. They may ask you if you were treated for any of the illnesses for more than so many days. Did you get admitted in a hospital for any kind of an emergency and things like that? If so, disclose the details. If you don't disclose the details, at a later point of time when they find out that your future claim is going to be based on that, right? In the future when they realize that, they may refute the claims. But currently, IRDA has been strict with the policy providers telling whatever homework you want to do it in the first year. After 1 year, you cannot reject the claims. Okay, but still they have given first 1 year in which maximum time for you to decide whether to service the policy or not, right? Just give me a second. I'll have some water. So we looked at indemnity, we looked at utmost good faith. Now we are looking at something called subrogation. Now what is subrogation? Now because we spoke about indemnity, this is with link to the indemnity. Now what did indemnity say? Making good for the losses, right? Now let me give you a small example. Now don't tell me, sir, why every time you are going back to the car, because it's a very good example and very convenient for multiple aspects to be explained. Okay, let us say that you are having a car which is worth 10 lakh. Okay, and this entire car got damaged, complete damage. Okay, so there was some kind of an accident, the entire car got damaged. So what will happen? Because it is a complete damage, they compensate you, right? Because you have not underinsured it. Because it is 10 lakh worth, you insured for 10 lakh, they compensate you 100% compensation, they pay you 10 lakh. Now let us assume that they paid you 10 lakh and then they left. They paid you 10 lakh and then they left. You know what? After that, you will go to the scrap. Whatever the damaged car, is there. In that there is a scrap, right? There is metal, there is engine, there is some things which may be working. Now, if you go and try to take out those parts and sell them in the market, you may end up making maybe another 1 to 2 lakh. I'm talking about a best case scenario, that you may be ending up making some more money. Now, when you are in a position to make this 1 or 2 lakhs, is it not profitable to you now? The loss is for 10 lakh. You end up making 10 lakh from insurance company and 1 to 2 lakhs from selling those scrap, which makes you profitable. Now, what did indemnity say? You cannot be profitable. So, what will they do? The insurance company will pay you 10 lakh and then they will take the scrap. So, the entire car is taken by them. So, they will take the car and say, I will recover it. So, what will they do? They will recover the 2 lakhs. That insurance company can recover because they compensated you. Now, that's what you need to understand. The basic pretext is the subrogation will only kick in if the claim is being settled. So, for the subrogation to kick in, the claim of insurance should be first settled. Means the 10 lakh compensation for the loss of the car should be first paid. So, the insurance company will first go pay the 10 lakh to the insured and say, my friend, your money is paid. Now that your money is being paid, the car scrap belongs to me. Now, what will I do? I will go and I will try to reclaim whatever I can. And even insurance company cannot reclaim more than 10 lakhs. Of course, there is no possibility, but still, in the worst case scenario, there can be some liability clauses, okay, where, say, in the car, it is a property, so there is absolute value. But there can be liability clauses where you can sue them for higher value. But even the insurance company cannot make a profit. So they can only claim from that particular scrap to an extent of maximum 10 lakh because that is the compensation you paid. If for some reason, let us imagine that, they could generate more than that, then that needs to be given to the policy holder. The insurance company cannot keep it. The possibilities are low except in liability cases, but still that is a point. So I thought I will put it. Okay. So the two important points here, subrogation will kick in once the claim is settled. The second point is after settling the claim, the insurer can take the steps to recover the compensation from the party that caused the losses. So this is the liability, right? So here the car accident was a plain context, right? So what we saw in the car accident is a plain. Okay, you went, you hit and you had a damage. Or there was some malfunction in the car and there was some fire which was caught in the engine or some transmission place, and then you just left the car and the car got damaged. Okay, but imagine that there is a car accident. You are doing right, somebody comes in a wrong way and hits your car, and then there is a huge entire damage happening. Now, the insurance company can pay you for the damages of 10 lakh. Then what will he do? He will not sit quiet because the loss is because of the other party's failure to follow something. So what will he do? He will go and file case on the other party, telling that because he did not follow traffic rules, he came in a one-way traffic in the opposite direction, the accident happened. So the insurance company will go and fight the case against him. Now his insurance company will have to pay him. That fellow's insurance company may end up paying, right? Or if the insurance company is not paying, then the individual will have to pay the insurance company. So the insurance company can recover. So the insurer can take steps to recover the compensation from the party that caused the losses, whichever party that caused the losses. Okay. Again, as I said, the insurance company also cannot profit in the process of recovering the compensation. If I have compensated only up to an extent of 10 lakh rupees, that is an extent I can claim. I cannot go beyond that. In case, if I am going beyond that, then that money will have to be given to the individual. I cannot pocket it. Consideration. I think we discussed about consideration in the one of the previous slides, right? So a promise from one person to do something, right, or provide a service for another person identifies the contractual component. So there are two parties, and in insurance, what is happening? The two parties are insured and the company, right? So what are the two parties here? You have insured and the insurance company. Now, insured will pay to the insurance company premium, correct? And the insurance company will pay the insured the claims, correct? Or in case of life insurance, there is something called maturity, right? That is in case of only life insurance, because all other policies do not have any maturity benefit. You buy a bike insurance or a car insurance or a health insurance, they don't come with maturity benefits. But in life insurance only, you have maturity benefits that comes in, right? Which means that there is no claim. You survive the entire period, then I will pay you at the end of the period some money. Now, this premium that you pay and the claims or the maturity benefit that the insurance company pays, they become part of the consideration, right? Now, in this case, the contract is for future term. Let us say I buy a insurance policy. Now, I am telling that I will pay you 10,000 rupees premium. You cover me for 50 lakhs. Okay. Now, the insurance company will say, okay, I will insure you for 50 lakhs. Okay. For a period of maybe 15 years or 20 years, you pay me 10,000 premium. Now, I have to pay every year 10,000 rupees as a premium. That is the promise I am making as part of the consideration. And the insurance company is making a promise in the contract telling that in case of something happening to you, in case of a death within the time frame, that 15 years or 20 years, whatever the policy tenure, I will pay you 50 lakhs. I will compensate 50 lakhs. That is a consideration, right? So the premium paid by me and the maturity amount or the claim settlement paid by the insurance company, both of them becomes part of your consideration. Claims. Now, in the entire insurance, what becomes most important is the claims. As I said, right, my objective of buying insurance is that tomorrow an event happens and there is a losses, that losses needs to be compensated. Now, at that time, if the losses is not compensated, the entire objective of buying insurance itself is defeated, right? Now, let us say that you are having an insurance on your bike or car and you are paying it every year for 15 years. And in the 15th year, there is an accident. And in that year, then they don't pay the claims. Then the basic purpose is defeated, right? Because in the last 14 years, there was not even a single claim. And when the claim happens, they don't pay you money. The basic objective is defeated, right? So claim settlement is the litmus test of the insurance policy. Whether I have succeeded in getting an insurance from the right person, similarly, has the insurance company settled the claims at the right time, that becomes the litmus test in case of insurance. If you are not getting paid in time, and if they are rejecting the claim, or for whatever reason there is something not happening in time, then there is going to be the loss which is to be compensated where the compensation has not happened. Means the basic objective is lost. Your entire insurance transfer of risk management is all gone for a toss. So that becomes your litmus test. Now, insurance policies generally require the insured to notify the insurer of a loss within a specified time, such as immediately or promptly within a certain number of days. Now, we need to understand when it comes to the claims, the insurance company also wants to ensure that there is a process being followed. Now, why there is a requirement for process being followed? Right? Now, typically, if you see when there is a event of crime happening, right? There is a crime happening. Then immediately there is some kind of an investigation team that comes in, and they first thing what they do is they will completely barricade that area, right? Nobody will be allowed to get in and get out, right? Then they try to collect all kinds of evidences, maybe physical evidence, fingerprints, blood, whatever it is, right? They try to collect all kinds of evidences because they don't want the crime scene to be modified or manipulated by anybody's entry or exit or any event happening there after that. Similarly, what happens whenever there is an insurance claim that is happening, they want you to tell immediately to a particular claim settlement mechanism. through a claim settlement mechanism. Let us say there is an accident. They will tell you, immediately you should inform within so many hours. Why would they tell that? Because if there is an accident, they want to ensure that the homework is done in time. That there is somebody visiting from the insurance company to understand who is at the fault. Right? As we saw in subrogation, right? If the insurance company can recover something from another party, the insurance company will end up paying you only for that. The proof of loss clause. So again, this is like the who is accountable to prove, right? The proof of loss clause may be a conditional requirement for the insured to recover under the policy. Now, the insurance company may ask you to prove why or how this particular loss has happened, if it is not very evident. Now, if the complaint or the claim complaint is made immediately, then maybe they can come and evaluate the process. But if it is not done in time, there is a possibility that the insurance company will put you at stake and now you tell how the loss happened and prove us. Because it is delayed. We don't see any proper evidence of things. How do you prove that this is how it has happened? They may put it on you. Right? So with respect to the claims, there is do and not do's, which we need to be very cautious of. And remember, claim is the litmus test for your insurance. If it is not paid in time, then your entire insurance goes for a toss. Then comes proximate cause. These are all slightly away from the four things what we saw. So in the slide what we saw in the insurance contract, we saw indemnity, utmost good faith, subrogation, right? And consideration, right? Now here we are talking of perils. We spoke of perils, which is a cause of loss. But here there is another concept of proximate cause. Again, as I said, these are concepts which are very specific with respect to insurance. Now, what is a proximate cause? Now, peril is a cause of loss. So, we saw that, right? When we discussed about hazards also, right? Now, in perils, the insurance company can always choose what is it I cover, what is it I don't cover. When you come and ask me for an insurance cover, I am going to tell you, I am going to cover you for these things. I am not going to cover you for these things. Like insured perils, uninsured or uncovered perils. And then there are other perils, means not discussed, okay, excluded, not discussed at all. So when they are telling insured perils, they are telling I am going to cover you only for A, B, C, D. If it is not from this A, B, C, D, please don't come to me. I am not going to pay the claim. Similarly, they will tell that I will insure you for these things, but some things are excluded. Now let us say, in case of uncovered perils, what can it be? Right? Now, if you look at a health insurance, somebody goes and applies for a health insurance, there is an exclusion. The uncovered perils are also called exclusions. Okay. So they will say exclusions. Pre-existing illnesses are excluded for first 4 years or few years. Some companies may be slightly lesser or more, typically somewhere around 4 years. So what they are telling is, if you come and buy medical insurance from me, I will provide you the cover, but whatever is the pre-existing conditions, I am not going to cover for next 4 years. After 4 years, I will cover it. Now, why this cooling off period of 4 years? This is primarily to ensure what are one of the conditions of insurable risk? It should be accidental. Now, if there is a pre-existing illness, you cannot take an insurance and then you cannot make a claim for a pre-existing illness because that is not accidental. It is already known to you. So, it is planned. Somebody says you have to undergo this particular kind of a treatment or a surgery, then you go to a medical insurance company and then take insurance and then you get the treatment done. Now, is it accidental? No, it is not accidental. It is known to you already. It was more or less evident. So, to avoid that and make it as an accidental thing, right? To make it an insurable risk, they are telling pre-existing illnesses we are not covering for next maybe n number of years. That is an exclusion. Similarly, when we are talking about driving, right, there are exclusions. So what are the exclusions? That the vehicle should be driven by someone who is having a valid driving license. If you don't have a valid driving license, then we are not going to cover you, right? If you are driving under the influence of some substance, we are not going to cover you, right? More importantly, which people don't understand is, when you are having a private vehicle, you are not supposed to use your private vehicle for commercial use. Private vehicle is used for private purposes, right? If you are trying to ply goods in your private vehicle and then there is some losses happening and then there is an accident, and then you go and claim. And when the claim settlement is happening, when in the process, when they figure out that what you are carrying in your private car was not for your personal use, right? And it was something which was supposed to be for a commercial use, then it is uncovered because it is for personal use, not for commercial use. So this is the way they try to ensure that the claims are being covered or not covered and settled or not settled according to the pre-decided conditions, right? Now, what is proximate cause? We saw about perils, covered, uncovered. What is proximate cause? Now, what happens? Sometimes there can be a chain of events that will happen. There can be a chain of events, right? So we keep seeing in some movies, right? There is one car which slows down. One car which suddenly slows down, and then everybody starts coming back and they start hitting, right? And then there can be an accident that will happen. And then you will see dozens and dozens of vehicles getting hit. It's a chain of events, right? Now, when we talk about the proximate cause, we are telling there can be a chain of events that is leading to the losses. Now, let us say, what are the chain of events? There was a fire. Okay, there was a fire, and because of the fire, there is some damage that is happening, and immediately the owner called up the fire station, and the fire engine came in time, and then they started putting water, and firefighting was done. And at the end of the entire thing, the fire engine left, and the owner comes back and sees, and incidentally he figures out that the losses by fire is 10%, and the losses by the water put by the fire engine is maybe 30%. So 40% is a loss, and 10% is by fire, and 30% is by water. Now the insurance company cannot come and say that this is not the losses because of fire, right? Why? Because why did the water come there in the first place? The water did not come just like that. The water came there because of the fire. So that is a chain of events. There was a fire, there was damage, then the fire engine came, it started putting in a lot of water and fighting the fire, and in the process there was a damage happening. So in the chain of events, what is the cause? Proximate cause? Fire is the proximate cause. And is fire covered? Yes, it is covered. Then the claim will be settled. So a proximate cause is basically on that. A chain of events or causes rather than a single cause leads to the loss. If an insured peril directly gives rise to the loss, then it will be covered, provided there was no uncovered peril that effectively interrupted the chain of events. There is no uncovered peril that has interrupted the chain of events. So in the chain of events, there should not be something uncovered. If there is something uncovered that comes there, then the claim may be rejected, right? For example, loss due to smoke or water in case of fire. So I was giving you the example of water in case of fire. Similarly, there can be loss due to smoke also, right? Let us say that there is fire. Fire is covered, and that fire caused a lot of smoke, and that smoke has led to other losses. Maybe the quality of the materials that were stored in the warehouse, they got badly affected because of the smoke, right? It is not because of fire, but it is because of the smoke. Fire would burn. The smoke did not burn, but it has hampered the quality of the materials or the goods that is stored there. So it is a loss again, but not because of fire, but because of the smoke. But the smoke happened because of the fire, and fire is a covered peril, so the losses will be compensated. So that is what the proximate cause is. So let us understand there is a chain of events, and in the chain of events, the chain should not be broken by any uncovered peril. That's the main important point here. Then there are some very unique aspects with respect to insurance contract. This is something which I wanted to understand. Okay, we saw that insurance itself as a subject area has various concepts we discussed, and now I am telling with respect to the insurance contract, right? I am talking about the contract. There are some very unique aspects of it. Now, what are the various unique aspects with respect to the insurance contract? The first one is the insurance contract is a contract of adhesion. Now, what does this mean? Now, when insurance contract is being made, who is drafting the contract? Am I making the draft, or is the insurance company making the draft? I don't make the draft, right? I go to the insurance company, I tell the insurance company, please take this risk. and cover me from the losses that can happen from this. Then the insurance company is underwriting it, and then they are drafting a contract and then telling, okay, you pay this premium, I will cover this, and this is what are the terms and conditions. So they are drafting it. Now, because the insurance policy is a contract of adhesion, means that party has to implement the entire policy conditions from the company's side. They are obliged to live with the conditions of the entire contract because you have put the contract terms. All the terms were put by me, so it is my responsibility to live by all those conditions. All of them put together, not again selectively, right? I made the terms of the contract and I will have to abide by the terms of the contract in completion. There is no bits and pieces here. The second one is insurance contract is unilateral. Now, why are we telling unilateral? Again, similar to what is in adhesion, right? I am getting into an insurance contract. Let me take the same example I gave some time back. I pay 10,000 rupees premium. You cover me for 50 lakh rupees for next 10 years. Okay, which means every year I will pay you 10,000. You cover me for 50 lakh rupees. If there is an eventuality happening sometime in the next 10 years, you end up paying me for the losses. If there is no eventuality happening, you don't pay me for anything, right? So the insurance contract is unilateral because I may decide not to pay the premium. You can't come and force me. I pay premium for 2 years and third year I will say, no, I don't want insurance cover, so I will not pay the premium. Can you come and force me to pay the premium? You can't make me to pay the premium. So the insurance contract is unilateral. From the insurance company's point of view, you cannot go back. But from the insured point of view, I can anytime go back and I can say that, my friend, I don't want this cover, so I am stopping the premium, so please don't cover me. It's okay. But insurance company cannot say. That's why it is called unilateral. Insurance contract is aleatory in nature. Now, this is again very important word. Now, when we say insurance contract is aleatory in nature, what we are telling is it is very disproportionate in nature. Why is it disproportionate in nature? Now, let us look at the example we were discussing, right? So, this is Mr. X and this is the company XYZ, which is an insurance company, right? So, he says, I will pay you a premium of 10,000 and the insurance company will say, I will pay you 50 lakh in case of loss of life. If there is no loss of life, they will not pay. Now, let us look at it. This fellow will pay 10,000 rupees premium. Let us say he paid 10,000 rupees premium and 6 months down the line, there is a accidental death to this person. He died in an accident. The insurance company will pay 50 lakhs. See how asymmetric it is. This fellow is only paying 10,000, but the insurance company has to compensate by paying 50 lakh rupees. So asymmetrical, right? Where is 10,000? Where is 50 lakhs? Typically in a contract, it is symmetrical, right? What you give, what you get is somewhere balancing out. But here in insurance, they will not balance out, right? Similarly, there can be another scenario. Okay, so what could be the other scenario? The other scenario is wherein, just give me. Wherein there is Mr. X and then there is insurance company XYZ Limited. So X was paying 10,000 rupees premium every year. He paid and paid and paid for 15 years and he survived the entire term. He paid 10,000 rupees every year for 15 years and then he survived the term. Now what will the insurance company pay? The insurance company will only pay zero, nothing. Because it's a policy where in case of an eventuality happening, it is paid. Because you survived the entire term, I will not pay anything. Now in 15 years, how much did X pay? He ended up paying 1,50,000 rupees cumulatively as a premium. And he got zero from the insurance company. That is also asymmetric. So when you pay 10,000 rupees or 20,000 rupees, there is a claim and the insurance company is paying 50,000. It is asymmetric. You paid 10,000, you got 50 lakh rupees compensation. Similarly, you pay 10,000 rupees for 15 years and no claim happens, you get nothing. So you paid 1,50,000, you got nothing. That is also asymmetric. Now that is why these contracts are called aleatory contracts, which means the insurance contracts are not very proportionate in nature. What you pay and what you get may not seem very proportionate. Then finally, the insurance policy is conditional. Insurance as a contract, when I am getting into it, it is conditional. Now there can be multiple. Now who is putting the conditions? We saw it is a contract of adhesion. So who is making the contract? The insurance company is making the contract. So who is putting the conditions? The insurance company is going to put the conditions, right? And one of the basic conditions in the insurance contract is that the policy should be active, which means you should have paid adequate premiums in time. If you have not made adequate premiums in time, your policy is expired. And any claim happening if the policy is expired may not be settled. Any claims which is after the policy expiry may not be settled. So that is a condition. The premium should be paid. There can be other conditions. Based on the underwriting, they may give some specific conditions. Like I said, in the property insurance, they may say you need to put fire extinguishers. They may say that you need to have these kind of fire alarm systems, right? Or smoke alarm systems. So all these things are conditions that is being put. Now, if you fail to satisfy those conditions, the insurance contract by default will become inoperational. The claim may not be settled, right? Now, I think with this, we have covered most of the content in the first chapter. I think very few aspects are limited, right? Left over. So let us quickly see what we have covered today. So this is where we started today, right? So we looked at the specific concepts with respect to insurance, where we looked at insurable interest, indemnity, utmost good faith, and subrogation, right? Insurable interest, where I am having a legal interest to claim because I suffer the losses financially in case of any loss happening to that, right? That's what is insurable interest. And insurable interest needs to exist when I am taking the policy and also when there is a loss happening. And there are exceptions, we discussed on that. Similarly, indemnity. In indemnity, we saw that indemnity is ensuring that you make good for the losses. Whatever is the losses that is incurred, that is being compensated. Primarily, I am not going to make you in a profitable position. You cannot be let to make profits in case of a event happening, right? And then utmost good faith or uberrima fide, which means that you have to disclose all the information pre-contract and post-contract, whatever is relevant to the subject matter of insurance. So that is where we discussed about material fact. Whatever the facts that is important with respect to underwriter's decision to cover or not is a material fact, right? So we discussed about utmost good faith. And in disclosure also, pre-contract disclosure, post-contract disclosures, right? Then comes subrogation. And we saw for subrogation that indemnity is the basic pretext there. I compensate you for the losses, and because the insurance policy says that you cannot make profit, I will try to reclaim. I have the right to reclaim any damages from the other party which might have caused the losses. So that's what is the right the subrogation gives me. That's what we saw. Then we discussed about claims being the litmus test, because the entire insurance is about the claims. If I cannot get the claim settled, the entire process of doing the risk management is a futile job, right? Then proximate cause, we saw peril, hazard, and in the proximate cause, we looked at the chain of events. And the chain of events, if the chain is broken, most important in the proximate cause, if the chain is broken by an uninsured peril, then the losses may not be compensated. And then we looked at the various unique aspects of insurance contract, wherein we saw about adhesion, unilateral, aleatory, and conditional. So this is what we discussed in the last. So I think, with this, we come to the end of today's session. So more or less, we are done with the first chapter with risk management. So looking forward to meeting you all in the next session. Thank you guys. Have a nice day.